Well, hello there and welcome to the Mines and Money Gold Junior Exploration Investment Outlook 2021 session. And what a great Mines and Money conference we've had this week. And thanks for joining us from wherever you are. My name is Richard Morrow and I'm the chairman of the Melbourne Mining Club. I'm in Melbourne, Victoria, Australia, where it's summer, but it's raining and miserable outside, unfortunately, this morning. But it's morning for me, but it may well be your afternoon or evening for that matter. The Melbourne Mining Club is delighted to support the Mines and Money events, and in particular this one. It's been a tremendous effort. Anyway, wherever you are, I'm welcoming you, and now I'm also welcoming, and I'm delighted to welcome our all-star panel today. We're going to kick around a few ideas here, and hopefully we'll all learn something about the global, and it is a global junior gold sector, and it's a global panel. Welcome to Adrian Day. Adrian is the chairman and chief executive officer of Adrian Day Asset Management. He's in Puerto Rico. Close to my home is Barry Dawes, executive chairman of Martin Place Securities in Sydney. Lawrence Roulston is Managing Director of West Bay Advisors in Vancouver. Matt Geiger, Managing Partner of MJG Capital Management in San Francisco. And rounding out the panel is Ivan Bebek, Chair and Director of Fury Gold Mines in Vancouver. Welcome to the panel. Today's topic is all about gold junior exploration investment outlook for the year ahead. That's a topic close to my heart and to those of our panelists today. Investors have been tipping money into listed exploration company at a furious rate over the last 12 months. Boom conditions for capital raising, and I'm pleased to say that the capital is being put to good use. Exploration is booming. Old projects are being looked at with fresh eyes. New projects are being generated, and a range of technologies are being developed and used to peer through cover. We've come up with a few winners here in Australia this time around. Some of the discoveries have potential to become long life profitable assets. In Western Australia, we have Chalice with its polymetallic Julimar project, De Grey with its new gold camp making itself known at Hemi, and the mighty Rio Tinto's Winu copper discovery in the Pilbara. In New South Wales, we have Alkane's Boda copper gold project, and in my home state of Victoria, we have Staveley's Kaylee copper lode and gold, and a potential deeper porphyry target in a deeper setting there. Let's face it, most of the easy to find deposits have been found, and the task ahead involves searching further, harder, and dare I say it, smarter. The downside is with all this capital being invested in the ground, assay labs are themselves being tested to the limits and sample turnaround times are stretched. But it's all about the prize. And with gold above 1,800 US dollars, silver above 25, and pretty exciting day in the silver market today, and copper around that $3.50 a pound, the prize is definitely worth chasing. I've got plenty of questions for the panel, but you, our audience, probably have a few questions yourself as we go along. So please feel free to put those questions to the panel via the chat function, and we'll try to get to them. So let's do it, shall we? Panel? We are certainly in a bull market for exploration in Australia and North America, but it looks like certain parts of the world are valuations. The first question for the panel is, has any region been left behind in this excitement? And where do you think the best opportunities lie around the world at the moment? Regions that have left behind, greenfield versus brownfield exploration, where are those laggards? Adrian Day of Adrian Day Asset Management, where should we be looking for value and laggard opportunities?
Let's start with the laggards. I think most of the regions that are lagging in exploration are for two reasons. One is political risk. Neither of these is a surprise. One will be political risk, and that would be some of the obvious places: West Africa, Eastern Europe, even. Although we might consider it a good place to work, but there's a perception. California, if you want, political risk in the United States. And I think the other factor, apart from political risk, would be where the holding costs, because of holding onto properties, are abnormally high. And that might be places like, say, Egypt, as well as Chile. Chile is a obviously a first-class mining jurisdiction, but the cost of holding on to a lot of ground is very, very high, particularly for junior companies, which are doing most of the exploration. So I think if you're looking for, places, some of those might be places to look, leaving out California. Some of those might be places to look, yeah.
That's interesting. I hadn't even considered that California. That's really interesting. Barry Dawes from Martin Place Securities and author of the famed Dawes Point newsletter, one of the best pieces of research and thought on the Aussie scene. Barry, any laggards you like?
Well, I think it's sort of, I take a different approach on it. If you like, we've really started from the centre of the universe, from Australia's point of view, which is the Yilgarn and around Kalgoorlie, and so we've developed from there, and we're spreading. There's a lot of infill in the Yilgarn around Kalgoorlie. It's amazing what we're finding. So a lot of those things are still quite cheap and are laggards, but the Yilgarn produces about 60% of Australia's gold. Australia is the second largest gold producer, and I think it will become the largest producer by 2023 as China continues to decline. But as we spread, we've got Victoria, and I guess everybody knows Fosterville, and that magnificent mine, a very high grade, most impressive operation, and that's revitalised activity in Victoria. So Victoria's still one of the laggards, but it's improving. And we've got a bit, as you've mentioned, in New South Wales. There's next to nothing happening in Queensland relative to what's going on in WA, even though there's a pegging rush there. Likewise for the Northern Territory, South Australia, and there's a bit of action in Tasmania. So what's happening, the Australian gold mining industry is leading the world. And the gold sector's bottomed in Australia in 2013, and it's basically leading everything. So as we go further afield, now the risk profiles are becoming acceptable to go into West Africa, South Africa, and other parts of Africa that they're still developing, and also we've got into South America, and of course Southeast Asia. So there are many opportunities which are really driven by the expertise that the Australian mining entrepreneurial sector in gold is able to drive. So lots of opportunities everywhere, and I've had a great opportunity with this Mines and Money in the last one, catching up with the activities in North America. And I'm really quite impressed with what I've seen. There's still a lot of value in a lot of those companies. And I think investors just need to do due diligence, listen to some wise words. And in this fabulous gold bull market we've got, I think there'll be outstanding returns coming.
Thank you, Barry. That's great comments. Matt Geiger, Managing Partner of MJG Capital Management. You see a lot of projects, but is there anywhere that people aren't looking?
So I think the two previous guests covered a lot of ground there. I'll zero in on one of the regions Adrian touched on. He mentioned Eastern Europe. I would define that as the Balkans. And I like that region for a handful of reasons. The first would be, of course, the mineral endowment of the West Tethyan belt, stretching into those countries there. A whole host of different deposits. You have copper, gold porphyries. You have, lead, zinc, silver, VMS mineralization. You have epithermal gold. You have uranium even in the region. So there's a whole host of different types of deposits to go after there. Additionally, I really like the brownfield exploration opportunity that's presented by these ex-Soviet workings that are in the area. You see a lot of mines there that stopped producing in the late 80s, early 90s. And those often for reasons besides depletion or even too low of metal prices. It could have been political upheaval, it could have been war. And so I think for companies using modern exploration methods, it's a great place to start looking for properties or for new deposits in the general proximity there. I'll also say quickly, interestingly, because of the Soviets' controlled economy, they were not particularly interested in precious metals. Their focus was always lead and zinc and in copper. And sure, if some gold and silver were in the mineralization they were pulling up, they would process it and try to monetize it, but they weren't chasing precious metals by any respect. So I think there's quite a bit of opportunity really close to existing mine sites for that to be further fleshed out by modern day companies. So an interesting region. You know, there's corruption, permitting is slow. There's a lot of struggles, but I think the opportunity is there with the right team.
You've got to go where the gold is, don't you? Is the old saying. Ivan Bebek from Fury Gold Mines, you are the explorationist on our panel, and you have been very successful in raising capital for exploration over the years. You may not want to give away your best ideas, but where should we be looking?
You know what? It's gone a lot harder for starters. You know, every mine that's been sticking out of the ground has been found, and you know, we spent one of the leading, through the bear market expenditures on looking for it. Northern Canada, none of it. Big place of potential endowment. Agnico just took over TMAC. That's their second major or third major mining camp up there. So great address, tough. You have to be able to raise the money and have the tenacity to go up there and weather that storm up there that you have to deal with in terms of remoteness. But Peru is really a big laggard for me, and we're doing business there as well. And the reason why is because the permitting is slow. We've waited 2 years on an asset to get permits, and we've seen a major shift with the government through COVID. And what we're seeing now, not only was the government impeached, the president impeached, but the COVID really impacted the country, and a large proponent of their GDP comes from mining. So when you talk about what's a laggard and where do you want to be, Peru's probably number one globally for endowment, underpicked, underexplored, due to social challenges in some areas, or the Andean, the higher elevation kind of projects to go after. But it has some of the world's biggest mines there. And so I like it as an early version of Nevada that has not had the access Nevada has had. And then lastly, going forward, the big shift in Peru, which we're experiencing firsthand with some of our companies, is the government's pro-mining, looking to streamline, improve the permitting process down there. So I think if you want to make a world-class discovery in an emerging South American country that's going to have the metal endowment that you're going to be able to do business in, that's going in the right direction as a shift through the whole COVID experience, I think Peru ranks as one of the best places. I've done business in West Africa, found a big mine there. The challenge you have to watch out for is metal prices. If metal prices go too high, when we were in Ghana, the government increased their NSRs from 3.5% to 5.5%, and taxes went from 20 to 30%. So I'm cautious. I like to go where a lot of people haven't gone or won't go. I'm brave that way. But at the same time, I'm mindful that some places don't have the history, or the governments can be corrupt to a certain degree. So mindful that way.
That's an interesting point you bring in. As governments around the world are boosting their fiscal stimulus, they've got to get the money from somewhere. I mean, it's easy pickings from the mining sector, isn't it? Something you take into account from an investment standpoint. Lawrence Roulston from West Bay Advisors. How should we be examining that idea of the fiscal settings also, and from an overarching investment point of view?
Well, first of all, a couple of general comments. Just stepping back a minute, we're focused on gold, but I think silver is a really important part of that, and the other precious metals should also be considered. They're also, to a certain extent, seen the same way by investors. And, with regard to this idea of overlooked jurisdictions and laggards, it's the classic undervalued situation. It's undervalued today, but what is going to change to make it not undervalued in the future? And, political risk and all the other risk factors and, climate and remoteness and, my view, and I've spent decades traveling all over the world looking at mines and exploration projects in every part of the world. And I sit back here and I think, well, you know what, we've got so much right at hand. Richard, you mentioned some good examples in Australia that have, new discoveries in areas that have been looked at for years. And I'm certainly seeing the same thing here in Canada. Great Bear with a multi-$100 million market valuation, with a discovery that was looked at and looked at and looked at in a camp that's been mined for 100 years. And Tudor, another example here, a multi-$100 million market valuation in an area right beside, something that's been looked at for decades. So, my personal view is you don't need to go to the ends of the earth to find these great overlooked opportunities. And, you know, there are so many risk factors that we don't need to take on. Exploration is risky enough. And so my focus has been looking at stuff in more favorable jurisdictions, and in particular in Canada, where we've got a geological data set to work from, and we've got a much lower risk profile. So that's my overall assessment. And I'd just like to make one more quick comment. You know, we all talk, you know, the group of us here, and I suspect many of the people at the conference are people very familiar with the mining industry. But I think we need also to talk to some people that we're trying to lure in that don't understand the mining industry. And why are we focused on these junior exploration companies? And I think it's worth noting that the gold industry produces 100 million ounces a year, more or less. And unless we find 100 million ounces a year, the industry is fading away. So that's the reason that we need to look at these juniors, and that they're such an integral part of the global gold mining industry.
Interesting. The World Gold Council numbers out the other day were talking about gold production in 20 down 5% on the previous year. Do you think that that's reflective of maybe not enough capital invested in exploration and development over the previous 5 years there on that one, Lawrence?
It's hard.
Well, I think one other important aspect there is that the grades are declining. So there's the same amount of rock going through the plants, but there's less ounces of gold coming out at the end of the process. So that's an important trend in the gold industry.
Ivan, you were saying something there?
I'm just saying it's a lot harder to find. So money's been spent, I think 20 billion in the last 20 years looking for it, right? And it goes back to my earlier point, being a serial explorationist, it's not as easy, because anything that was easy was found. And new concepts, new ideas, as Lawrence pointed out, that's going to be the leading part in a lot of the known good jurisdictions. But you know, any new discovery that's made and to lure more investors in, it's going to be worth a lot more than it was worth in previous markets, because the market hasn't gotten smaller. If anything, it's gotten bigger, and the discovery rate's going down huge amounts. So for us explorers, it's really tough, but that's going to meet with really big rewards, much bigger than previously. So it's an exciting time if you get it, if you find it, but it's a challenging time to go look for it. Just because the gold price is up doesn't mean it's easy to go find a gold mine, and easier. It's actually, in fact, proving it to be more difficult.
It's a chicken and egg in a certain way, isn't it? You know, what comes first, the idea or the money? And there's a bit of a conveyor belt too, isn't it? To a certain degree, is that you raise the money, and then you spend it in the ground, and then you come up with your results. And you know, it doesn't always link in with commodity prices on that one. Adrian Day, do you have any thoughts on that?
Yeah, I mean, a couple of thoughts. One is, I in most markets, except extreme bear markets or credit collapses, I think if a company has good management, you know, experienced management, if they have a good idea, they can raise the money. Now, some people in Canada and Vancouver are not going to like what I'm going to say, but I think it's too easy to raise money for junior mining companies, because too many bad companies raise money. But the point is, if you have an experienced management with a plan, with an idea, you can raise the money. And if you put it in the ground and have good results, you can raise the money again. So I'm not concerned about raising the money. And as Ivan mentioned, I think Lawrence alluded to, but Ivan mentioned, money is not for lack of spending money. If you look at the numbers, other than a spike in 2011-12, when the price of gold went up, and suddenly everybody started looking for gold, all the marijuana companies started looking for gold. But the amount of money spent worldwide looking for gold has slowly, steadily increased over the last 30, 40 years. It's not that we're not spending the money.
Good point, Adrian. We might circle back to that idea a little bit later in the hour. But I want to get back to something that we had mentioned there from Ivan on grade. You know, what actually moves a junior share market these days? I mean, in Australia, it's high ground, underground opportunities that are winning over investors these days. But what's it like in the rest of the world? What are investors looking for most these days? I mean, grade is king down here, but what's it like out there? You know, Matt Geiger from MJG Capital, how do you think on that?
Sure. So when I would frame this almost as a fund manager. My focus is what are the major companies looking for, more so than what is working with investors. And I do think grade is part of the answer. You do need a certain amount of scale. Just having high grade hits on its own is not gonna work if it doesn't hold together or isn't of a scale that moves the needle for a bigger producer. But what I think we saw in the last cycle, you know, especially going into 2006, 2007, and then when things heated up again in 2009, 2010, early 2011, is we saw the major companies really across most of the metals, but specifically with precious metals, really splurge on these large, high capex, low grade, bulk tonnage projects that at the time looked great. But here we are 10 years later, and most of them have stagnated for that entire period. And I think a lot of the majors are regretting those acquisitions. Certainly the management teams that made that decision are, because they're off in a lot of cases aren't in a job right now. So I think if you're looking at potentially you know, acquirable projects, you need to make sure it is of the right scale, but it also needs to work at spot metal prices, if not lower. And so, you know, that's more of a bias. You know, some investors like to swing big and make big directional bets on metal prices. And if that's your game, then you know, don't ignore this advice. But I think if you're looking to back projects, and whether they're, you know, post discoveries stage exploration or, you know, further along the development pipeline, focus on those projects that have after-tax NPVs well north of the initial capex. Focus on those projects that, you know, using reasonable assumptions have IRRs in the high 20s or 30s and above. Focus on those projects with quick paybacks, you know, hopefully 3-4 years or less. And I think that will serve you well as an investor. In terms of what the market's looking at, you know, it's everybody's really greedy at the moment, and so there's a lot of promotion and flair. A lot of people are focused on the given metals that are being focused on by a company, but if you don't have the right people, if you don't have the right company structure, it's not well financed, it's not a high quality asset. It doesn't matter what metal the company's focused on ultimately.
Yeah, well, you know, when you mention those about what are the big companies doing, yeah, big companies like scale. They like big projects. They like something to really sink their teeth into. Maybe the early stage juniors are more developing those really sort of juicy, higher grade sort of situations. Barry Dawes, how are you seeing it, mate, on that?
Well, I think as Matt mentioned, it's really management and making sure you've got serious players, making sure that the projects are reasonable. But we've seen a real influx of new people, new money over the last 6 or 9 months in Australia, and it's good to see these people come. Many of them are inexperienced, but within those management teams, they've often got people who have had now 10 or 15 years experience. And we didn't have that in the sort of 2011 peak market. We just didn't have the experienced management. So I'm a lot more confident about that. But if we look at what's happening in Australia, and I mentioned earlier on that the Australian gold mining industry is really leading the world in terms of activity. It's been doing it for longer, and we've got the runs on the board in terms of production earnings, dividends, cash flow, balance sheet, etc. But in Australia, our September exploration numbers were running at $1.4 billion annualized, which is up 40% on a year earlier. And here in Australia, we've had finding costs which have been well under $50 an ounce. So if we're spending well over $1 billion, we're finding over 20 million ounces a year, and we can see that. You can see it in things like De Grey with their hemi projects. But right across the board, we are finding more and more resource. And the other really important point is because we've got a lot of infrastructure in terms of milling and processing facilities, people can go and find a small deposit, which might only be 20 or 30,000 ounces, and truck it down the road to the nearest milling plant, and with operating costs of, say, under $1,500 AUD, they're making $1,000 an ounce margin. So there's a lot of activity, and as Lawrence said, look, you're based in Canada and you're finding a lot of new things around existing fields, and it's exactly the same with the number of discoveries that we're seeing around Kalgoorlie even. And what we're also noting is the discovery of deposits in lithologies that would not have been looked for previously. So it's a matter of seeing where the gold is, or looking for where the gold might be, rather than thinking that the geology and lithology is going to determine the site. So lots of opportunities, right throughout, and it comes back to just making sure you get the management right.
It's very important management. There's management very important for you, Lawrence Roulston of West Bay Advisors. How does that rate on your scale?
Well, I would rate management as number one, and number two I would rate as management, and number three I would put down as the team. Look, it's really important, and as I was saying earlier, there's lots of these things that have been looked at in the past, and people missed it. They looked at it, they walked away from it. So coming back with a fresh mind, and innovative thinking. But also a really, really important element of management is being able to instill the confidence among investors to secure the money they need to advance the project. And so, yeah, absolutely, people, management, most important, and technical team, of course, an incredibly important part of that is really the most important aspect of any company.
It's a pity we can't clone a good mining company manager, isn't it? It's amazing how many times a good team will make you money over your investment career, isn't it, Adrian Day?
Oh yeah, I mean, there's a mining legend in Vancouver called Ross Beatty, and he's described as a broken slot machine that just keeps on paying. So yeah, I couldn't agree more. I'm not a geologist. I'm not a technical, I'm not a mining engineer or anything. So for me, I don't have any particular advantage if I'm looking at a project on a geology. So for me, management is absolutely number one. And I always say that in exploration, good management, even if they have a lousy property and no money, good management can raise the money, and they will also, and this is very important, they will also be more likely to determine that a project is bad and give it up and move on than promoters who will just stick with a bad project and spend too much time and money on it.
Excellent comment there. Just around this this question up, Ivan Bebek of Fury Gold Mines, grade or tons?
Grade is king. It solves all problems, and it is the most important factor in profitability. I'll take grade any day. It's number one.
I'll take cost.
There we go.
I'll take cost.
Anyone else?
Grade will solve the challenging cost too. I mean, it solves everything from in the middle of nowhere or in the perfect place that will give you the biggest profit margin and likely the lowest cost. Because if you have grade, you move a lot less rock, right? Versus the tonnage. But yeah, on the sense of, we always can't estimate cost because we need to know the scale, but grade is always one for us in all of our minds of where we can make the most money.
Excellent discussion there, guys. Let's move along now, shall we? Cash is piling up inside the coffers of our producers while reserves are being depleted. A breakout of M&A is virtually assured, in my humble opinion. In Australia, we've recently had the merger between Northern Star and Saracen, the centerpiece of which is 100% ownership of Kalgoorlie Super Pit. Will we see juniors being gobbled up this year. Why and when and where and how? Is there an Aussie segue here somewhere, Barry Dawes?
Oh, look, I think we'll see all sorts of M&A. If we talk about Northern Star and Saracen, I mean, that's a very special company which is combined with another excellent company. And so we've got a really extraordinarily well-managed, well-financed company. It's going to go places. The cash flows that are coming basically mean that they've got to pay more and more dividends because mines are depleting assets, and shareholders need to get the returns from those and not necessarily put back into acquisition. I think Northern Star in particular has done an excellent job in its M&A, and with some of the bigger ones, they're actually divesting. I see more mergers and consolidations amongst the sort of second and third liners, just to give them a bit more gravitas. I'm a great believer that in management teams, and as all you guys have mentioned, and it's usually the people who are on the ground running a project have the best appreciation of that project, and that those projects aren't usually well managed by people who are at a bureaucratic level higher up. So we've got to have sort of more mergers of near equals to give them more gravitas, more activity in the market. But as I keep talking about, exploration dollars are continuing to grow, and it means that there's a lot of activity. So more money that we can get into these, say, merged companies, I think we're going to find more discoveries, greenfields, brownfields. In Australia, we've still got about 68% of our area under cover. So some of these remote sensing things are becoming more and more important. So yeah, the people that run projects, that manage these companies are much better hands-on players than people who might be portfolio managers or strategic thinkers in bigger companies. But lots of action.
Yeah, Matt Geiger, we had Newmont's Australian CEO, Tom Palmer, in the media here talking about the need for more consolidation in the space. It was only earlier this week. What are your thoughts on that one?
Sure. Well, I do think the environment is ripe for M&A. It's not a very controversial opinion at the moment. I would say there's a slight caveat, but generally, the reasoning why we're in a really good, especially for gold and silver, consolidation period here. I would argue what we saw between March and August, kind of this euphoric frenzy and sharp rises in the prices of gold and silver. Those types of environments will almost put a chilling effect on potential M&A. Because the sellers feel like that gold is going through the moon and they don't want to sell out too soon, whereas the buyers feel like they're getting a bad price and they don't want to chase. But really, since August, we've now had a period where gold and silver settled into a set trading range. There's less energy and excitement around it. So I do think we're in good shape for that specific reason. That said, I will comment that projects in more far-flung jurisdictions, we might see a little bit of a delay before there's M&A activity around there. I do think the COVID factor is a big one, and especially for a well-managed mining company, it's negligent not to do multiple site visits and get your boots on the ground with your top technical advisors and key decision makers if you're going to make a big acquisition. In a lot of cases, that's not been possible because of COVID. I will say, though, in certain jurisdictions where major mining companies are headquartered, whether it's Canada, the United States, or Australia, it is a little bit easier to potentially get employees and the right decision makers onto the ground there. But in certain far-flung jurisdictions, I think we might need to wait till we see the vaccine before we start to see groups really confident pulling the trigger on those types of assets.
Yeah, that's too right. Adrian Day, merger mania, value creating for shareholders or just fee spinners for the investment bankers?
Well, that's a good question, because all too often in the past, and I don't even mean 10 years ago, but all too often you see a merger and you really start scratching your head saying, is there anything about this merger other than just getting bigger? Now, let's be honest, as has been sort of alluded to several times, for the company that's producing 5 million ounces a year, they have to find 5 or a little bit more, obviously, because of wastage. They have to find 5 million ounces a year, and that's not easy. So to stay where they are, and no shareholder likes to see their company deliberately shrink itself. That's not a winning sort of strategy to say over the next 5 years, we intend to get smaller. You know, they have to make acquisitions, but the market generally, and I agree with this, there's too many mergers where you really scratch your head and say, well, where's the synergy? Where are the cost savings? You know, a $1 billion merger, and they're talking about saving maybe 50 million on overhead. You know, and there's no mines that are close to each other. There's no savings. That just doesn't cut it for me. No. But I think to a large extent, management teams have also learned. As Matt said, there were a lot of management turnover after the mania we saw in 2010-11 with just buying big things, overpaying for marginal deposits. 75% of the money spent in the gold mining industry in 2010 and 11, 75% was written off within 3 years, not written down, written off. Just a waste, an absolute waste of capital.
Do you reckon that's there's something else going on there behind that? It's not, you don't 75%, you just don't put a line through. Do you? Obviously, there might have been other reasons for that, or do you think it was just value destruction?
Well, some of it will come back, no question. Hope Bay, for example, some of it will come back. But clearly, I don't think it's controversial to say they spent too much, they overpaid for marginal assets that will not be put into production for many, many years to come. Now, the companies will tell you they were simply getting pressure from their shareholders. Shareholders were pressuring them, gold is at 1900, soon it's going to be 2500. Where's your pipeline? Go and buy something. They were getting pressure. And maybe that's true. But the smart people in the business, the smartest people in the business are counter-cyclical. They know this is a cyclical business. We're never going to see a straight line up for 30 years. It's a cyclical business. You have to buy when things are cheap, and you have to have the money to buy when things are cheap, which means which means you don't buy when things are expensive, and you preserve your capital. And we can all think of companies that acted that way, but unfortunately, they were the minority.
Ivan Bebek, Fury, you're our man out there in the market. How do you think COVID's impacted on corporate activity? You can't send your team out there to kick the rocks, or you can, but it's very, very difficult. And are you people like yourself looking over your shoulder for the next bid?
Yeah, so a couple comments there, and thanks for asking that question. Just on the M&A, we're coming out of a bear market, right? And if you all know what happens in a bear market, big mining companies, they lay off everybody that goes and finds it, and the growth profile gets destroyed, right? From an internal exploration perspective, we hired Newmont's former global exploration team in the downturn of the bear market. And then we took a check from Goldcorp for $37 million at a 25% premium to our share price down the road after that, because Goldcorp didn't have that technical team to go find it. These are kind of consequences of a bear market. And then to Barry's point earlier about the mergers that they're talking about, Tom Palmer and whatnot, I mean, the more companies with the production curse of having to replace ounces makes a lot more competition for all the big companies to grow. So if you can't grow through finding new things, you're best off all to merge and have that gravitas scale and to grow laterally versus vertically, and that's, I think you're going to see some of that for sure. But the most important M&A that we look for is at the beginning of a bull market or at the end of the bull market when people make silly decisions, as Adrian was pointing out just a moment ago. And the big merger we saw at the beginning of this bull market was Newmont buying Goldcorp, and it became the biggest gold company. So there's been enough activity, and also Barrick and Randgold. I mean, there's been some big M&A that's happened. For juniors, the majors are definitely coming down to the juniors now because they've done two things. Either they've shelved their exploration teams or they have high graded some of their mines, and they're going to have a tough time finding those ounces. And we're seeing a lot of corporate interest and a lot of corporate intrigue, but we're in no rush anytime soon. We believe this market is barely started. And we also believe our discoveries get a lot bigger, or deposits get a lot bigger than they are right now. And we're drilling 100,000 meters in the next 12 to 18 months to make things bigger. And I'm not trying to self-promote my company, but I'm just saying that that kind of approach could add enough ounces to make a difference for a bigger company. So when we operate as a company, our CEO is from Agnico Eagle. Our SVP is a former global structuralist of Newmont. We think as a major and we operate as a major without the red tape. So whenever we look at the space, we look at projects, or we look at the scale of things we're going for, what might fit a major, or try to get a test in the climate, we do it with that kind of intel, right? And then secondly, in terms of COVID and the environment, we've operated successfully. We have 2 drills turning as we speak. We're sending people down to projects in Peru. We are operating under the COVID rules. We test people on the way into camp, on the way out of camp. We have the most strict guidelines possible. To go into Committee Bay this year, we're going to have to get none of it needs to be vaccinated before we can go up, and they will be in that time. So it's slowing things down. The biggest slowdown was the assay labs, and it's not the labs themselves. It's the assay prep labs that have been the issue because they've been understaffed. There was a massive bottleneck that's been resolved, and now they're working under COVID guidelines. So I think assay times are going to start to improve for everyone. But it's a long of the short. Do we see it? We see it definitely on the horizon because we are, we have a portfolio. We're looking to provide a pipeline of growth as well, internal growth as well as discovery growth in our company. And we just hope not to get into those discussions anytime soon because we're obviously optimistic.
Yeah, that's. We might circle back to that issue of the assay labs a little bit later if we get time. But the Lawrence Roulston of West Bay Advisors there. What do you prefer your gold and silver companies to do? Find it or buy it? Oh, we've lost you. There we go. We got you. Sorry, start again, mate. No, we've lost you there. Keep talking.
You're on mute.
Sorry, there we go.
That's all right.
Okay, I'm all about finding it. And just to elaborate a little bit on what Ivan was just saying, there's no question that the larger companies, the producers, want to buy ounces, but at the same time, they do not want to take on risk. And now that there is money in the industry, and Ivan's company is a perfect example, there's money, they're spending that money, and they're de-risking the projects. And I think it's not so much the knowledge that there are ounces in the ground, it's getting them to the level where the producers are prepared to sign off on the risk aspect. So with the juniors having lots of money at the moment, work is underway, projects are being de-risked, I think we're going to start to see a lot of takeovers coming once they get to the appropriate level of risk profile. And once that process starts, and we've seen it in multiple previous cycles, that as soon as the juniors start to get taken over by the larger companies, then the investors are speculating on who's next in line. And that's going to start to drive the value of some of the other juniors that are seen to be in that potential pipeline of other takeovers.
Yeah, it's interesting in Oz, especially in these great West Australian discoveries we've had recently. Finding costs maybe somewhere $20, $40 an ounce. Yet they're looking for and heading towards valuations of $100 of market cap or EV per ounce in the ground. Any numbers that sort of spin off the top of your head on in your part of the world, or the things you're looking at?
Well, the values are all over, and of course it's a spectrum depending on the risk level. So, you know, I think to me, it looks like the larger companies would rather pay $100 an ounce for something with a lower risk profile than pay $20 and take on the risk that comes with an earlier stage project. So there's that trade-off, and you know, as the cycle goes on and it gets more competitive, we're probably going to see it shift more toward the earlier stage projects where they will end up paying a higher price in any event.
You know, I was listening to a Sprott webcast recently, you know, and they were talking about the, you know, still having those sort of $100-ish an ounce in the ground ideas in terms of valuation. And then, during that time, the gold price had gone from 1,300 up to 1,800. So we had $500 of movement in the gold price, but very little movement in the valuations. Are you seeing anything like that at all?
I know
it's a tough question.
Yeah. Maybe someone else that's more in tune with that aspect of the market.
Adrian Day.
Yeah,
I'm sorry. I was just going to say, there's no question the majors are being, in my view, they're being very, very conservative by and large at the moment. And a lot of that is because of the thing we've all talked about, which is, you know, the mistakes that were made earlier, the management turnovers, and the sort of new mantra. None of the seniors talk about growth anymore. You know, they talk about profitable ounces and all that kind of stuff, but nobody's talking about, the seniors are talking about growth. And if you look at the price that they're valuing reserves, and the price that they're looking at judging projects, it's very, very conservative right now. You know, that will have to change, obviously, if the price of gold stays higher and moves even higher. So on a sustained basis, they'll obviously have to adjust. But at the moment, most of the seniors are being particularly conservative, I think.
Matt Geiger.
Richard, if I can jump in quickly, I'd just like to caution listeners here on using that metric in terms of valuation per ounce on the ground, at least on a company specific level. I think it can tell us some interesting, you know, thoughts on where we are in the market if you look at it generally. But it's important to emphasize, as panelists have mentioned, not all ounces are created equal, right? If you're looking at dollar value per ounce on the ground, you're not factoring in infrastructure. You're not factoring in metallurgy. You aren't factoring in how deep that mineralization is. So there's a whole bunch of different focus. So it's an interesting metric. If you're analyzing specific companies, I wouldn't get too sucked into it, though. Just as a word of caution.
Just to add to
definitely, definitely there. So sorry, Ivan. Yeah.
Just to add to that, Matt and Adrian both have great points on it. But if you have a really big growth pile, say you have a speculative look that's, you know, of multi-million, 5-10 million ounces, and you've only found 1 million ounces so far, the major is going to pay way more per ounce with that kind of growth behind it. So it really comes down to the exact metrics of the ounces. To Matt's point, you know, what's the cost of getting them out? What's the metallurgy? What's your jurisdiction? Everything plays a factor. So it's not as easy as a staple number. But on the other point Adrian made, the market, the majors, and we saw this with all the M&A, we always see it at the top of the market. Shareholders push for growth. They make these big acquisitions that don't always make sense. There's a lag. There's a big lag. And so the trick is, as an investor, to get in before they start paying more later. And I think we're all of the same mindset that the ounce, the value per ounce on all of these ounces, whether they're good ounces or great ounces, is going to go up over time. So it's a really good point in cycle to be looking at gold, you know, kind of companies at this stage, exploration ones anyway, for that matter.
Well, thank you for that, Ivan. And wow, that we've still got a lot to talk about. We're coming to an end. It's been a great hour or thereabouts, and I want to thank our contributors today: Adrian Day, Chairman and Chief Executive Officer of Adrian Day Asset Management; Barry Dawes, Executive Chairman of Martin Place Securities in Sydney; Lawrence Roulston, Managing Director of West Bay Advisors; Matt Geiger, Managing Partner of MJG Capital Management; and of course, Ivan Bebek, Chair and Director of Fury Gold Mines, listed on the TXX. And thank you, gentlemen, for your comments today. Very generous with your time. And thank you from Mines and Money, and thank you from the Melbourne Mining Club.
Thank you for having me.
Thank you, Richard. It's been fun.
Thanks, guys. Nice to see you all.